Hi, it's Andy Kim back again in Behavioral Finance and FinTech, your second week portion of it. Last time we talked about why EMH is so much important in neoclassical economics. The social planner's perspective, right? The price is central mechanism for resource allocation in the market, right? In an efficient manner. For that purpose, the price has to reflect the information available, right? What if it does not? Everything gets screwed up. So that's a problem. We are pointing to the fourth one, which is about the corporate governance over here. Here, the EMH matters again. That's why the behavioral corporate finance is an important one. Well, before that, what is corporate governance, right? We have to set up the idea first, right? Andre Schleifer at Harvard University Business School, right? He says like that. Well, it's about getting my money back, right? Getting my money back. My precious money back. Whose money? My shareholders. He's a principal. And from whom? The agent, the CEO. Why do we have this kind of governance problem? Because there is a separation of ownership and control. If you are the CEO and then the owner of the company, the only shareholder managing your company, your own venture, there's no such thing as agency problem. You don't need to worry about corporate governance. Why? If you screw up and then don't work hard for your business, you will screw up your business and you will screw up yourself, right? Nobody else gets screwed up. But if there's a separation between the ownership versus control, right? Those CEOs that we hired and then we hope and pray that he's going to work or she's going to work hard in their corner office after closing their doors, right? Good luck. What if he doesn't, or what if she does not, right? What's that? The objective function of this CEO is different from the objective function of the principal, the shareholders. The objective of the CEO is to maximize what? His or her own utility maximization, rational guy, right? Whatever way of maximizing utility that, I'm going to work that way. Okay? Is it necessarily working hard or doing something fishy? Okay? Drinking like alcohol like crazy. Yeah? Who knows? Shareholders, their objective function is what? Maximizing shareholder values, right? I want you to maximize my shareholder value, share price. I want it to go up, right? This is the concern of principal, right? There's a principal agent problem, agency problem. How can we resolve this situation? We have to align those incentives. We need incentive alignments by giving some kind of incentive, economic incentives to the CEOs. Oh, the CEO, you're not an owner of this company? Well, let's make you one of us. Let's make you one of us so that you will feel like one of us, right? The shareholders. So I give you the share ownership or call option for these stocks, right? So that once you work hard, the information that you are working hard gets priced so that the price goes up. And then you will be happier. So the incentive gets aligned. You happy, me happy, right? 누이 좋고 매부 좋고 kind of in Korean terminology, right? So the case of KD Media is of my favorite example over here during 2012 Gangnam Style bubble. We're going to talk about the Gangnam Style later on, but here's one interesting finding, right? One of the CEO at that time was my friend, and then the stock was traded at the Kosdaq market. The thing is, Gangnam Style, the Psy's video got viral all around the world. Psy's father's stock, DI Corp, was in a bubble. But not only that company, but also all other companies that had some relation with the size previously started to suffer from this kind of, or enjoy this kind of stock price bubble. KD Media happened to be the one who produced the kind of album jacket to Psy long time before. So people were starting to speculating, oh, this is a Psy-related stock, Tematju, or some kind of theme stock in Korea, or hot in fashion, associated with Psy. Who knows? Psy will come back to this company and then, boost up their business somehow. So people started to buy this stock like crazy. The price started to deviate from the fundamental values, and then was high flying. Okay. Now, guess what happened to these employees in this company? They started to look at the computer screen more busily instead of working hard. Why? Trying to time the market. When should I sell my stock? The employee ownership plan kind of things, and then stock option kind of things, right? When is my optimal time to sell off? Oh, wait. It's like this, right? So my friend complained to me, Andy, the incentives does not work. We gave them stock options and then ownership so that they will be able to work harder. But because it is in the bubble, they have no reason to work harder. Already there, oh my God, they're selling off, right? So that's a problem if the price is not efficient, right? If correct, security prices can play key governance roles. Incorrect prices compromise this role. Number 5, the allocation of capital across firms. There, the market efficiency also matters. What the heck do you mean? The undergraduate students without work experience will have a hard time understanding this. But for MBA students, once they have job experience in their real companies, they will realize it. Once you start to work in a certain company, their political line, in which division do you belong to, and who you stand behind, right? Matters a lot. Why? Different divisions within a company, they fight for the limited budget every year, right? Give me more money, please, Mr. CEO or Miss CEO. I want more money in my division to feed my family, my people in my division, right? My subordinates. But the CEO will have to allocate this limited budget among different divisions. There has to be some rule. What should be the resource allocation rule? That's Tobin's Q, or price to book ratio kind of ideas. What's the idea there? Tobin's Q, price to book ratio. Well, the denominator is what you already invested. The numerator is how much the market perceives about your investment. So for a given dollar of investment, how much does the market treat you? Willing to buy for that. For a single dollar of investment that you invested previously, if the market is giving you more than $1, more than what you invested, you will be happy. Okay? So Tobin's Q being bigger than 1 means that the market welcomes your investment in that business. So comparing division 1 versus the other, right? Rule number 1 is put your money to highest Tobin's Q division, okay? Because the market welcomes, right? If the Tobin's Q is low or even worse than 1, lower than 1, that tells us that you have to scrap that business and dump it and lay off those people or retool those people, reallocate to the more promising division. So natural reallocation of the resource happens that way. Okay? Not just reallocation, but the allocation itself of the budget matters. Their EMH works critically. So the market value, okay, market value should be the price times the number of shares outstanding, kind of things, right? So that price in the market has to reflect the information available to the full. That's what market efficiency is about. What if it is not efficient? Then your decision rule gets screwed, right? You're in trouble. That's what this is about. Now, looking at Hyundai Motors, right? Our good old friend. Hello, Mr. 정몽구 and then 정의선형. Yes. They have different divisions, right? Conventional combustion engine, gasoline engine car division versus electric car division versus hydrogen fuel division, the car divisions, right? They will fight for budget, and then 의선이 형 has to make a decision. Where should we allocate our budget more? Well, if market is efficient, just look at the Tobin's Q and then the highest Tobin's Q. You put your resources over there. Okay? Perhaps the electric car market because Tesla is flying high. Hydrogen car market, should we invest it or not? You look at the Tobin's Q. There you may say, oh, there comes Nikola Truck Company, right? Some of you who has watched that news closely may say, oh my God, that Nikola was welcomed in the market. So why don't we put more money into that? That's something you have to trace the market, okay? How that changes, right? Remember, Nikola's stock price tumbled down by 50% after IPO. So there is some bubble element over there. And electric car market is not an exception as well. So many people are, buying Tesla these days because there's no other choices. Is it in the bubble? Is a big concern. Okay, for resource allocation purposes, these kind of things matter a lot. And then efficient market hypothesis is a central concern over there. Okay, so that's what this slide is telling you about. Okay. Yeah. Now the next section that I'm going to talk about is the theoretical underpinnings of EMH, right? And then we're going to talk about the 3 scenarios backing up EMH. Now, what is the economics behind the EMH is a question here. The starting point is this. The market price P is the outcome of what? Supply and demand. It gets back to your economics 101, which means your microeconomics, the principle, right? 경제원론, right? Baby step. Remember supply and demand curve, and the price is the where supply and demand curve meet each other. Equilibrium, right? The market clears over there, price is determined, and the market participants are price takers, whether you are the consumers or the suppliers, the companies, right? That was the concept of competition in the market, equilibrium, right? We will see that EMH can be thought of as a hypothesis about the relative shape and position of supply and demand curve, right? Now, supply and demand framework is clear way to think about the difference between behavioral versus neoclassical economics, finance. Now, supply curve for a security of a company. Okay, let's think about one company, Amazon, right? The supply curve traces the quantity supplied to the market as a function of the security's current price, P. How many shares of Amazon.com are supplied today? Well, 500 million shares outstanding. Supply is set by the firm's primary market. Primary means IPO. When you print, the shares, number of shares outstanding, once it is determined, it is fixed. Okay. 발행 주식수 in Korean terminology, shares outstanding in the short run, day by day, from today to tomorrow, it's fixed. Okay, no matter what the prices are. So that's the reality. Okay, what if the price goes up or down? It doesn't matter. It's just fixed, unless the company says we're going to increase the number of shares outstanding. Okay, usually it is fixed. So the supply curve will be like this. This is price and quantity, and then of Amazon over here. Vertical line. You see this? Let me expand my picture. Hello. Yes. Bigger. Yes. Like this. Okay? And this is the origin, before I forget. Yeah, okay. Then, graphically, Amazon's supply curve and the security will look like this in the short run. Now, day-to-day price movement usually reflect fluctuations in aggregate demand. But aggregate demand curve traces out the quantity demanded by the investors in total as a function of price P. It aggregates each investor's own demand. So demand curve of your own personal demand curve for Amazon.com. How would it form? Okay, is the first question. Well, some of you may say what? Well, here, my demand curve for Amazon, when the price is high, I will demand a small amount or no amount. Okay, maybe over here. If it is lower, I will demand more. Okay, maybe to the infinity, and then something like this. Okay. Some of you may say, I will start to demand at a lower level and goes like this. Some of you may say this and that, like this. Okay, so many people have different demand quantity at different price level. So if you aggregate all those things, things may line up like this. Okay, downward sloping demand curve, you may imagine, I said. Okay. And where does the price form? Well, wherever the price meets the demand curve meets the supply curve, right? Over here. Ding. Right. P equals P star, true value. That is market efficiency. So the price over here will be like this. Okay? Now, the aggregate demand curve is a horizontal sum of all investors' personal demand curves. Current market prices where Amazon's supply curve intersects with investors' aggregate demand curve. There, you see it. Okay. Now, so EMH, right? The EMH is the hypothesis that the demand curve intersects supply curve at the specific point where price is equal to fundamental value and quantity is always 500 million shares today. As long as fundamental value does not change, as long as the intrinsic value, fundamental value does not change, P should not change like this over here. Okay? As long as there is no other information coming in, this should happen. But demand curve, is it really shaped like that? Is a valid question. What? Demand curve, isn't it always downward sloping? But wait a minute. If you know, okay, if you are rational and you have all the information available, and if you know by that the intrinsic value exactly as an investor, right? What will be your demand curve? Would it be really downward sloping like that? Right? Let's refresh our memories about the perfect competition market, especially in product market, and then we're going to move down to securities market later. But let's refresh our memories about the product market in a perfect competition. And each producers faced a certain kind of demand curve. In aggregate level, the demand curve and supply curve meet each other. That was the price that you faced and the quantity that you faced. Remember? And then in the market, perfect competition, each person in the demand side and each company in the supply side, they're just simple price takers. So not in the aggregate level, but in the individual company, right? Each company, what kind of demand curve did they face? Clearly, it was not downward sloping, but it was like this. here the same parallel price axis, and here's the quantity of individual company, right? And then the price, they are the price taker, has to be over here. The price taker is the same price. Yeah. But interesting thing is the demand, right? The demand. Over here, let me draw with another color. Blue, yeah, blue color. Yes. Over here. Here's a certain quantity that you're selling it. Okay. The thing is, if your company, let's say this is what, 엽기 떡볶이 kind of thing. If you don't know about 떡볶이 in Korea, go search in Google 떡볶이, TTO, like a 떡볶이 thing, right? Or snacks. Snack market, 떡볶이 market in Korea is very competitive. Let's say you are selling 엽기 떡볶이, and in this 떡볶이 price, you increase it a little bit. How many people will come and consume your 떡볶이? Nobody. Because the consumers in the market rationally know what has to be the market price of your 떡볶이. They will desert you if you increase the price. Okay? And what if you lower down your 떡볶이 price compared to the market price a little bit, just a little bit? So many people will swarm to your market and your demand quantity will shoot to infinity. Because they all know. Those consumers know about the competitive price of 떡볶이 right away. And so rationally behaving it makes their demand curve like flat like this. Remember that? Yeah. The same idea gets into here, right? So instead of having this downward sloping demand curve for your security Amazon, what you are going to have is a what's this? This horizontally flat demand curve like this, centered at, fixed at your true value of your stock. Make sense? Now, is this demand curve ever possible in securities market? Is a valid question. So, actually, 3 scenarios support this kind of flat horizontal demand curve for securities. Okay, for securities. 3 different scenarios. The first scenario is when all the investors in the market are rational. 100% of them are like just robots. It reminds me of the movie I, Robot, where all the agents are like behaving in a parallel manner, looking at the same direction and then get the same information and then think the same way and then respond in the same way. Okay? You get the same information in the market, and then your computation method is the same, and you estimate the right true value identically at the same time. Now, if the price deviates a little bit to the upwards, what will happen? Would you ever buy that security? And then all the agents, representative agents, will say, sell, no demand. So the demand will shrink down to 0. What if the price slightly deviates below this efficient level? Okay, slightly below. Then all these representative agents will turn on their eyes like ding, and then buy, and increase their demand like crazy to the infinity. Right? So that's the idea supporting these horizontal demand curve, right? Flat demand curve will happen with that scenario, right? Now the second scenario is this. Second scenario, let me draw a picture over here again. Yes. Over here. You see it? Right. Let's say this is the whole group of investors in the market, and a part of it they are rational, just like iRobot kind of guys. But there are some irrational guys in the market. But the thing is, there are some optimists and pessimists balancing each other out. Okay? Its balancing part is very important. So much so that they cancel each other out in their forces. The remaining guys are the rational guys. So the prices will be, the demand curve will be flat again. Okay? So that's the second scenario, right? Next is the third scenario, where we don't assume, equally balancing optimist and pessimist. We don't assume that. It may break the balance, but whatever breaking of the balance will be taken care of by arbitrageurs, right? Arbitrageurs. How do you pronounce it in French? I don't know. Arbitrage, arbitrages. I don't know. Maybe not. What is those arbitrageurs doing? Okay, what are those arbitrageurs doing? Right? They're short selling and then buying. They are taking long and short position. Okay, for a given asset. Think of arbitrageurs as big, rational investors who know precisely about the true value, well informed, right? And who know the intrinsic value and trade the big quantities when price deviates from the fundamentals, right? So even if some investors are systematically irrational or optimistic, these arbitrageurs might still enforce market efficiency. Arbitrageurs as avengers for the efficient market. Okay, I put it this way. Avengers, arbitrageurs, avengers, both starting with A. Good. So if they are big enough, arbitrageurs can effectively flatten the aggregate demand curve. So the idea is, if the price deviates from the fundamentals and then form a bubble like this going up, what will arbitrageurs do? Well, short sell. Short sell, short sell, short sell until it clears off all the deviation, right? So that the demand curve will be flat over there. What if the price deviates to lower level over here? The arbitrageurs will take long position. Buy, 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 right? Are you capable of buying that? Shut up. Yeah, we're going to be able to do that, right? This is Avengers, right? Iron Man kind of guys, right? Hope and pray that kind of arbitrageurs will be there. As long as you have it, you have flat demand curve, market efficiency holds true. So that's a third scenario, right? You can read off the rest of that slide, and that's basic idea. But the last thing is important. The bottom line, 3 different scenarios justify EMH. Still, are any of them realistic? Is a valid question. Avengers, good. Sounds sexy, but okay. Where does the thing stand? Okay. In 1978, Professor Michael Jensen of Harvard wrote like this: I believe there is no other proposition in economics which has more solid empirical evidence than the efficient market hypothesis. Good. But more recently, studies have turned up many question marks. So the next class notes, we are going to go through some of the significant evidence against EMH. Until now, I gave you the evidence for EMH, and there is evidence against EMH. It's going to be awfully exciting. Okay, see you.